All right, good morning, good afternoon. So this video will be on institutional order flow and daily bias. First and foremost, who is the targeted audience that I'm trying to target with this mentorship and with this series of videos? I'm trying to target the people that don't want a schedule being made for them, the people that want to independently take charge and take responsibility for their schedule, for their life, and every controllable aspect of their life. The aspects that they can't control, they will leave it up to fate, God, or the universe, whichever which you do believe in. The people I am trying to convey this language to are independent thinkers, people that will use this language to apply in their own view of price action and how they see the marketplace. So, with that being said, let's start with the institutional order flow. So, from the mid of April, we've been expecting lower prices for the dollar, hence higher prices for the currencies and the indices. So, from the last video, we noted this imbalance here and observed this rally higher here. And when you have an imbalance like this and prices interested in lower prices, these relative equal lows, the midpoint of this discount week and also the low of the week. When you're expecting lower prices like this, you do not expect price to fill in the first imbalance that was created. As you can see, there were two imbalances created during this leg down. This imbalance, and also there's an imbalance here from Friday's candle. There's an imbalance here. Now, because you're expecting lower prices on the dollar, you do not expect this to be filled. Price can trade one tick inside of it, inside of the imbalance, but the imbalance should not be filled. And from the video on elements to a trade setup, we noted 4 elements of a trade setup, and within these 4 elements of a trade setup, you had four primary PDRAs which were covered, which was the first one was the equilibrium, the second PDRA was fair value gaps and liquidity voids. The other PDRA is liquidity pools, that is buy side liquidity and sell side liquidity, and the fourth PDRA is order blocks. Those other blocks that are resting at equilibrium after an expansion. So those are the 4 main PDRAs that the algorithm uses to, that is the 4 main PDRA that the fingerprint of the algorithm does reveal itself. Now, for the institutional order flow, those reference points of those elements that we discussed earlier, those reference points are the signatures that the algorithm will look towards to rebalance price or to have a retracement in price before going to its intended joint liquidity. And to have a clear view of institutional order flow, you must first have a dawn liquidity. Dawn liquidity, you get this from the higher time frame, from the monthly, the weekly, and other times the daily time frame. The dawn liquidity is always needed to streamline yourself with the program that's being executed by the algorithm. So because from this day, from the 26th of June and this 27th of June, the algorithm has moved to a sell program from this short-term buy program, and it has changed its state of delivery to a sell program. Now, this last up close candle here that purged out buy side liquidity resting here, this last up close candle now is the order block. If you take this as a range from this low to this high, if you take this as a range, the midpoint of this range, you look for the candle, the last up close candle, which is being located at the midpoint, at the equilibrium of this. And as you can see, the equilibrium of this range from this swing low to this swing high, we are using this as a range. We are currently referencing the element of a trade setup to understand institutional order flows. Now, as you can see, when price traded lower here with this wick, we had an open higher here and we dropped lower here. And as you can see, from the 3rd of July, we opened lower. We opened at discount of this range. We opened at a lower price below equilibrium of this consolidating phase here, and we went higher to a premium above the equilibrium, above the 50% level of this range, which coincides with this order block. And you can see, from you use institutional order flow also to build narrative. The way price trades in every PDRA, it will give you the story as to how bearish or how bullish price is about to be. So if you take your fib and measure the bodies of this candle, you take your fib and look for the midpoint of this candle. We are currently on this order block now. When you take your fib and look for the body of this order block here, you notice when price was rallying above here, when price was after this opening, we are focusing on this candle now, the 3rd of July's candle. When price was rallying above here like this, we didn't see a candle close above the 50% of this, and price didn't spend long inside the second quadrant of the discount portion of this order block. And when you have something like this, the best fuse for sales, when you are bearish, the best fuse forms at 50% or below of that PDRA when you are bearish. And because price was uneager to get to the 50% and dropped lower, this will indicate the next trading day it will be extremely bearish. You are not wanting to see price trade back into this order block again. So when you have this drop in price, you note this as price trading into this order block and being unwilling to trade to the 50% of this quadrant of this PDRA here, of this order block, of this bearish order block. So on the next trading day, you will be looking for price to seek sell side and not wanting to be resisting premium PDRAs, and for it to be moving from premium PDRAs. Premium PDRAs are PDRAs which are above the 50% of a range, of a dealing range or of a range of a PDRA. So we'll go in depth into the premium and discount frame of thought later on. So when you add this drop in price leaving this consolidation phase, when you have this like this is price being eager to go lower for lower prices. Now, this gap, this gap now, because of how this narrative was being built up here, you will not expect this gap to be filled. You can have price trade a little bit inside of it, but you do not expect price to come to the 50% level of it. We noted that from the elements of a trade setup. When the market draws one-sided, there will be most times it will leave an imbalance in price. And when this imbalance is seen in price action, at a future time in price will have a retracement to give the participants that did not participate earlier in this PDRA year on this other block to sell lower. Price will give them another chance to enter, which we had this imbalance created here, this low of this candle and this high of this candle, and on the 9th of July price rallied inside of this imbalance. This is the imbalance we are currently referencing. This is the imbalance. Now, when you have price poised to go in a one-sided direction, lower in this case for the dollar, because the indices, the ES and the Nasdaq is running a buy program. That means you want to see price retracing higher to fill an old imbalance to go lower on the dollar. So which is what it did here. So we had this price go higher here to fill this imbalance here to go lower. For institutional order flows, when you have the program, when you understand the program being executed by the algorithm and you understand the draw on liquidity, you understand where you're expecting price to likely draw to, it will give you a framework to use these four reference points that were indicated from the institutional order flow. Sorry, it will give you a framework to use those reference points from the elements to a trade setup to use it as, in layman terms, in the support and resistance view of price. So reference points, those PDRAs that are resting above market price, they will be premium PDRAs, and those you want those premium PDRAs to resist price from going higher. The story should be those premium PDRAs, those PDRAs resting above the market price, they will resist price from going higher, and price will be wanting to draw to the PDRAs below market price, which are discount prices. So institutional order flow is you using those reference points as a framework to understand what reference points, what PDRAs is expected, is more likely to resist price from going higher, in this case for a bearish narrative. What reference points above the market price, above the current market price, will likely resist price from going higher, and what reference point below the current market price will be drawing price towards itself. So, and one of those reference points from the element of the trade setup we discussed was lows. was liquidity pools, which are relative equal lows. This here is a relative equal lows because of this body. This body is telling the story that they are relative equal lows here. So price will be gravitating below this relative equal low to the relative equal low and below it. When you have understood the reference points in this that makes up a trade setup that comprises this algorithm, this interbank price delivery algorithm, you will now, with that framework, understand that when price is in a sell program, the PDRAs that are the reference points, the PDRAs that are resting above that current market price, you will be expecting in your mind's eye those PDRAs to resist price from going higher. So they will act like a barrier above market price, taking price lower to the reference points which are currently below the market price. And to understand institutional order flow, it is not something that you can just listen to someone talk about and you go put live money on it. In the beginning of this video, I said the people, the individuals I am trying to convey this language to are individuals that want to be independent, that want to be an independent thinker, that have that independent mindset, because you are using this language that I'm relaying to you to understand your own reading in price action. It doesn't matter which market or which asset class you are trading or you are spectating. You will use this language that is being conveyed to you. You will use it as a framework to understand how this algorithm is booking price. So with that said, each individual day, when you want to look for a daily bias where you expect the day's range to likely draw to, you will then use this framework, this framework of PDRAs resting above market price to resist price from going higher, and price should be joined to the PDRAs which are resting below the current market price. And for this instance, we noted from the last video, we noted this relative equal lows, that price is likely to draw to these lows here. We noted that we're expecting this rally higher. We would want to see price come to at least the high of this candle here. If you watch the previous video, this was what was said. Would want to see price come probably at maximum to the high of this candle here and drop lower. And as you can see, we rallied higher. The wicks were shy of getting to this candle here, and we dropped lower because our bias is bearish on the dollar, because the order flow, the program being executed on the dollar is bearish. So every higher time frame reference point, every higher time frame PDRA, we are expecting those higher time frame PDRAs to resist price. This higher time frame PDRA here, why I was expecting price to come to the open of this here, is because this will act as a rejection block. So we want to see a body close. And from my own narrative, would want to see a body close here, but as you can see, we failed to go higher. This is indicating an extremely bearish price. And if you remember, we have this gap here, this breakaway gap. From the last two videos, we noted the breakaway gap. We discussed an introduction to the breakaway gap and explained that when you have a breakaway gap in price action, you're expecting an explosive move to a one-sided direction. So because of this breakaway gap here, price was extremely bearish. So hence why the dollar was extremely bearish, gravitating to these lows, to the midpoint of this imbalance, sorry, to the midpoint of this week and below it. To understand institutional order flow and daily bias, as you see, daily bias is not an everyday thing. Day trading, the idea of day trading is not an everyday, it does not correlate to everyday trading. You do not want to be trading every day. You want to buy back as much of your time as possible. So you do not want to be in this marketplace trading every day, because as Michael illustrates, the chart, the marketplace is a toxic lover. It's a very cruel lover. It requires all of your time. It requires all of you. It tries to take everything away from you. Once in a while, it shows you love, but most of the times it is a brutal lover. So you want to align yourself with those times. You want to understand on those days, from your backtesting section and from your tape reading session, and also your demo trading, while you were demo trading. Because currently, if you are watching this video now, you shouldn't be pushing a button. You shouldn't even be demoing, because I think we are in episode 15 or episode 16 of this mentorship. So you are in no way to be trading the market. You should just be spectating and indicating what you are seeing in price action, and you want to see how price gravitates towards those reference points that you've indicated in price, towards your fair value gap, towards your imbalance, towards your order blocks, towards your liquidity pools. You want to see how does price gravitate towards those level. So understanding how the algorithm is booked, it will give you a framework to understand your daily bias. So your daily bias should be most times in line with the weekly order flow. So where you're expecting the weekly candle to range to, that is where you would want your daily bias to be gravitating to. Your daily bias can also be a counter trend from the weekly narrative, from where you're expecting the weekly candle to draw to. And when you're trading in that aspect, it's advisable to trade with half the weeks or with a lower expectation in price, because that is currently a counter trend. And there are traders that are like this, that are trades that likes to trade the counter moves. So you shouldn't be put in a box, especially in this industry. You would want to find what gravitates to your personality, what reference points, and what elements in this marketplace, what gravitates to your personality, and you want to align that with what makes you unique. So your model, your days of entry, your days of trading will be solely unique to you, to your own personality. All right, one more thing. When your higher time frame drawn liquidity has been reached, you want to pause and do nothing, even if price is still delivering. If you have taken off your position, if you entered any position in the marketplace, you do not want to re-enter after your terminus has been reached, because for the dollar, this relative equal lows and the midpoint of this week was our door on liquidity. It has been reached. So for that reason, we are taking a break from the market and only observing, only spectating. You can use this time to do other things. You can touch some grass, but you do not want to be trading. For the indices market, for the ES is currently at an all-time high. And when a market is at an all-time high, there is no predicting if the market is still wanting to go higher or it is wanting to reverse. And you do not want to pick a top when the market is executing a buy program, because that is where most traders fall the trap of trying to pick tops in a bull market. And there is no draw on liquidity, there is no pool of liquidity, there's no liquidity pool, there's no previous imbalance that you can say this is the previous monthly imbalance that price is gravitating to for this buy program. So when trading in this direction, in these scenarios, it is better to take a pause, to wait for the algorithm, to wait for the market to present more information to for you to understand if the program that is being executed is wanting to be continued or price is anticipating a reversal in market. So you wait. Waiting is one skill that you have to build as a trader. Having patience is something you need as a trader, because impatience will make you impulsive, and when you are impulsive, you lack discipline. You you do you do nonsense in between waiting for price to give you good setups. So you want to develop patience in yourself. You use this time to develop patience when the market has reached your internet terminus. So it has reached our terminus currently here. So we are to do nothing but spectate and study your journals. So your journal entries, you should frequently visit your journals every 3 weeks to a month, like at least once every month or twice a month. So you want to visit your journal to solidify what was being written there. What your journal is currently you building a personal trading book for yourself. There's no trading book out there that can help you. Maybe some might help you with psychology and stuff like that, but there's no trading book out there that exists that can help you with actual trading or actual how you the individual, the independent thinker, how you view the market. It is your own journal, those notes you've written to yourself. Your journal is like a letter to your future self. So everything you input in that journal is you sending a letter, sending an instruction, a standard of operation to your future self. So when that future self, that you in the future, sees that message or sees that instruction, it will solidify itself as truth. And you want to be careful of what you write in your journal. You want to be very intentional and very conscious of what you write in your journal. Like, you do not want to be writing negative things to yourself in your journal, and you do not want to be writing lies in your journal, because when you write those lies, you will believe it as truth. So you want to align yourself with the truth, because the algorithm is truth. It is of a true nation. It is of a true notion that this market is controlled by an algorithm. So every algorithmic signature you see in price, every narrative the market presents itself, and how those narrative is being executed, you want to write those down in your journal and frequently visit those your journal entries, because it will help you in the long run. So I hope you got something from this video. The next video should be on the 25th of July or after then, because we'll be taking a few a week break, probably 2 weeks break from the market to tend to other aspects of life and probably do some back testing and some studying. During this time, when the market has reached this terminus and you are to do nothing, you shouldn't fall back to your old way of thinking, to how you think before, because most times when we are idle, when we have nothing doing, we'll revert back to our old self, that old self that is massively flawed, that old self that has not been worked on. We revert back to that self. So to counter this, you have to engage in other form of productivity. You can find a new skill, you can find a new hobby, probably learn a new language. Just do something. Make sure you do something to make sure your mind is not idle and being corruptible. So I hope you got something from this video, and see you when I see you, and have a nice day and goodbye.